Welcome back to the Without the Bank podcast, where you and I are going to talk about all things IBC, the business of banking, utilizing money correctly, and how this will help you grow your business and your wealth. Folks, I've said it before and I'm going to say it again, no fluff. I cannot stand podcasts with a lot of fluff. So let's get into it today and talk about seed versus harvest. Oh, this is going to be a good talk about the 401k and the money and the market scam, as I call it. And you are going to see a lot of that in the Life Without the Bank book because I have an entire chapter on it. And it is no hidden secret that Mary Jo does not like the stock market. Now, let me just preface this with, I am not a financial advisor, but guess what? It doesn't take a financial advisor to see the truth of what is going on here. And if you read my book, you are going to see some common sense numbers, and it's going to make you think a little bit about what are we truly being told to do. And so, I, like everybody else, when I was employed, I was told to go put money in the market. That's where you're supposed to have your money. And I did that. And then I lost 50% of it in 2008 and 2009. And I had just started kind of putting money there because I never bought into it. I was always looking for something better that had some guarantees because I am not a gambler. You guys, when I go to the casino with other people, I stand for hours and watch the craps table. I am fascinated with learning how it works and just watching people and seeing how they're, what they're doing and all that good stuff. And I never spend even a penny because it is such a waste to me. But yet, we are basically doing the same thing with a 401k and an IRA. We're putting it into a system where we don't really know for sure if we're going to have it when we retire. So think about this. When you want to buy a vehicle, do you put that money in the stock market? And then when you're ready to buy your vehicle, you go buy your vehicle? No, that's not what you do. What you do is put it in a savings account so you know it's there. Well, if you want to buy a vehicle, why not put it in the stock market? Makes little money, you get a better vehicle. Oh, because when we take it out, we have to pay taxes or we have a penalty. That's what we're talking about here today. Seed versus harvest. We are putting our money into a system that has the risk, it has the penalties, but it also has the taxes on the growth. And we are told we should take the tax benefit today and we should put it in there. And then when we retire, we should pay taxes then because we're going to be in a lower tax bracket. People actually think there is a different bracket for retirees. There is not a different tax bracket for retirees. They get treated the same. There are 3 essential tax buckets that I call them, and I do go over this in the book. Number 1, ordinary income. Anything that comes to us as payroll is ordinary income. We pay federal, state, Social Security, Medicare. Okay, we pay all of that. Then there is passive income, federal and state only. And then there is the no income tax bucket, where we don't pay anything, which is phenomenal. So most of us have ordinary income coming to us. We're taking payroll. If we are business owners and we have a LLC, that all flows up to us as ordinary income. If we take 401k and IRA money, that's ordinary income at retirement. Why do we want to pay in the highest tax bracket? We want to try to get our money to the no income tax bucket. Because guess what? At retirement, if you do exactly what the talking heads tell you to, you're not going to have any write-offs. None. You don't have kids. You don't have a mortgage. My clients that are 65 and older, are paying more taxes now than they did before because they did everything like they were supposed to. They saved and they maxed out that 401k, and now all that money comes to them as ordinary income. They're going to pay tax on the harvest. Right now, you are taking a tax break on the seed. Think about it. You put one seed in the ground of corn, and how many kernels does that produce? There are typically 3 ears of corn per stalk. Your one seed is going to produce 3 ears. That is what you are paying tax on if you have made money in the market. Even if you didn't make money, you're deferring the tax on what you put in. So if you've stuck $500,000 into 401ks, you never pay tax on the seed. You didn't pay tax on the $500,000 you put in. So you're now going to pay tax on the $500,000 you take out. And what's the tax bracket going to be at retirement? Nobody knows. I can make an assumption that taxes are most likely going to go up because we keep printing money in this country like it's water. So we're just going to keep raising taxes to pay for all the printing of money, to pay for all the debt. This is not rocket science. Think about it. I don't have one 65-year-old client or 55-year-old client that said they did it right. Not one. Because they come to me at 55 and 60 and say, how do I alleviate taxes now? There is no way, because all your money is in your 401k or your IRA. There is no way to alleviate taxes. You have to get it out of there. And when you take it out, you're going to pay taxes. That's all that's to it. And then guess what? If you've done a really, really, really good job of saving and you don't need the money, at 72, which is the new rule, at 72 years old, the government says, oh, you need to take the required minimum distribution. That required minimum distribution is the government saying you need to access your 401k money. If you do not, we are going to charge you a 50% tax on what the required minimum distribution should be. And that is a calculation of your age. And if you have a spouse, and you can go online and type in RMD calculator, and it'll give you calculators to figure out what your required minimum distribution is going to be. So if you've done a really good job and you've bought real estate and you have income coming in and you don't need any of your investment money, too bad, you're taking it anyway. And if you pass away and you leave that investment money to your kids, they have currently, at the time of this recording, they have 10 years, and then they have to take that money out. They don't get to keep passing it on. If they need it or not, they have to take it in a 10-year period of time because the government is going to get their taxes on the harvest. And most likely, we are going to be in a bigger tax bracket. We want to have our money moved into a system where we are paying no taxes, which is why we are utilizing the infinite banking concept and the life insurance as a tool. Because now, if we use the life insurance correctly, we will not be paying taxes on the income. This is not understood by everybody. I have had accountants tell me that this doesn't work because they've tried it and it didn't work because they did it wrong. They put money into not a whole life insurance policy, a universal life insurance policy. They took the money out rather than borrowing it. There are specific ways of how you need to utilize that policy so we are in the no tax bracket. If you are a business owner and you have a S Corp, any money that you take as a distribution comes to you as passive income, federal and state only. If you are an investor and you have rental properties, that income that is rental income comes to you as passive income, federal and state only. The worst tax bracket for us to be in is ordinary income. Wealthy people do not get their money through a paycheck. They are business owners. They are doing something that gives them the ability to move that income to passive or the no income tax bucket. We have to plan out for the future. What we're doing now and what we are told to do, put your money in an investment, take the tax break today, and pay the taxes later. We are paying tax on the harvest, not the seed. Here's another one to think about, my friends. If a Roth is so amazing, right? A lot of people will say, well, Mary Jo, I can do everything that you're doing in a Roth. No, you can't. A Roth, there is no guarantees. You can't borrow against it. It's not really liquid, right? Does it grow income tax free? Yes, it sure does. And then we have to ask the question, if that is so great, which it is, it's great because it grows income tax free. Why is the government limiting how much money we can put in those? Why are they doing that? Or if I make too much money, I can't put it in a Roth IRA because I don't qualify, I make too much. Why, when we have a halfway decent stock market tool, does the government limit us? Because we're not going to pay tax on the seed. In a Roth IRA, after 5 years, we can take that money out without penalty. We can take out what we put in without penalty. Per Google. Let me just tell you, I Googled that. So we have to pay attention. When we are putting money into the stock market, we're putting it at risk. We give up the liquidity of it. And guess what? We're paying tax on the harvest. We need to be smarter about how we are utilizing our money for retirement. If you're a business owner, why are you putting your money into a system that you're going to pay tax on later and you don't have any business deductions if you've sold the business? You don't have any expenses to write off. Now you're going to pay tax on all of that when you could have just paid tax today while you have the business expenses to write that off, to lower your tax burden. You're not going to have that when you're retired. You are offering your employees a system that isn't proven. It's proven to not really work. If it's working, then why are so many people struggling? Why are so many people concerned they're going to run out of money? So many retirees have money in the market. Why, on God's green earth, at 75 years old, do we have money in a mutual fund? Why do we want to risk losing it? Why don't we have it in a product that's guaranteed to grow? I don't care if it's bonds. Put it someplace where it's safe. Warren Buffett has said the only people that should be doing business in the market are the people that understand the market. And I'm venturing to say most financial advisors don't understand it. Think about it. Seed versus harvest. The long-term effect of what we are doing today can either be beneficial for us in the future or it can hurt us in the future. And of course, the majority of the people I see that are retirement age are having problems with taxes because they've done it incorrectly. That is what they've been told to do. They trusted. We didn't see this coming. We are in a generation that really, truly, the 65, 70, 75-year-olds started with this 401k. These things are only 46 years old. We don't have a proven method of what's going to happen. We only finally have the first full generation using this system. If you have not gotten the Life Without the Bank book yet, please go to withoutthebank.com, grab that book, and grab Becoming Your Own Banker by R. Nelson Nash. You will want both of those. Life Without the Bank is also in audio. So if you want to get that in audio, you sure can. And then you can grab Becoming Your Own Banker later. But I'm telling you, the two of them together are probably going to be the best lessons that you have on the infinite banking concept. Nelson's by far is my financial Bible. And I read it and read it and reread it and reread it. And I study it because there is a lot to know about our finances. There's a lot to know about our thought process, which is what I've gone over in a lot of my other podcasts. If you need anything, if you have questions about anything, please reach out to me, Mary Jo at withoutthebank.com. And I am happy to answer those for you if I can. But I'm always here, always looking for subjects. If you want something specific that you want to talk about, let me know and I will talk about it. Otherwise, you guys have a fantastic rest of your day, and I will see you in the next podcast.